Okay, good afternoon everybody. I'll jump straight into it today because I've got quite a lot to get through in this hour time frame. I'll start with a really high overview of the market, provide a snapshot. So the Australian share market's performing particularly strongly in recent times, which is quite remarkable considering half the country is still in some form of lockdown with no clear view of when this might end. So the share market's been willing to look through, I guess, the COVID disruptions in the eastern states. And I think that's sort of reflective of our experience last year, where we saw the economy recover quite swiftly and quite strongly once the lockdown ended. And I think the market's expecting that to happen again once the lockdown ends this time around. We have seen vaccinations accelerate in recent times. And again, that's reflective of, I guess, increased supply as well as a reduced hesitancy across people now. The country is we're currently vaccinating about 1% of the population every day now, which is quite high for a global standard and really encouraging. And it's likely that daily case numbers are soon to become an obsolete metric looking forward as governments and state leaders now consider the implications of, I guess, reducing some of the lockdown measures once we start hitting some of these vaccination threshold numbers like 70% and 80%. So reporting season is underway in Australia at the moment. So listed companies are reporting on their financial year earnings for the year, and so far so good. The earnings have been really quite strong, and that's reflective of improved business conditions for Australian businesses. So earnings are expected to be about 50% up year on year. Australian businesses are really quite strong. And we've seen a pickup in dividends and share buyback activity as well. So global share markets in developed regions such as USA, Canada, and parts of Europe are also trading near record highs at the moment. And again, it's really strong earnings that have been driving this performance, particularly in the US, who just announced earnings of 15% above expectations across the board in the US. So it's really this positive surprise that's been reinforcing, I guess, the upward trend in share prices in the US. And compared to the rest of the world, emerging markets probably hasn't performed as well in recent times, and that's partly responsible due to the performance in China. So China over the last 12 months have really cracked down and increased scrutiny across a number of sectors, including technology, education, and real estate. So since introducing or changing their policy to now allow Chinese families to have up to 3 children, China have really made an effort to increase or try and encourage population growth within their country. And this increased scrutiny or crackdown, if you like, is targeted to reduce anti-competitive practices, so reduce prices for families, and also improve education affordability for families as well. And whilst this has caused a little bit of volatility within the market, I do suspect that things will start to settle down in times to come as China are aware. China are fully aware that their growth within some of these innovative sectors are critical to their ongoing success. So global bonds have had a bit of a roller coaster year this year. They're currently up for the year, and that's reflecting declining bond yields, which signals economic growth expectations are becoming weaker as the Delta vaccine, I guess, hinders our growth forecasts going forward. And finally, cash. I think we can expect cash returns to be lower for longer as the RBA and central banks around the world maintain their stance to keep target interest rates near record low levels. So I'd like to spend some time now on discussing share market valuations. Since the COVID lows, or since the lows last year in March as a result of COVID, the market has now put on 88%. It's now increased 88%. It's almost doubled, which is quite staggering. And it's led to a lot of questions, not a lot of questions, but quite a few questions from clients wondering, are share markets becoming overvalued? Is the market overheating? So probably the most popular valuation measure used by analysts is the price to earnings ratio, or the PE ratio, which simply compares the share price of a company to its earnings or profits. And over time, and if you're looking at average, above average PE ratio, it tends to mean that the share is probably a little bit overpriced or expensive, and a below average PE ratio probably means the company is fairly priced or a little bit cheaper compared to the market. So looking at this chart, we're looking at the PE ratios over time, over the last 20 years. And as we can see, PE ratios really skyrocketed after this period of the COVID collapse. And even though we've seen earnings rebound and the PE ratios come down a little bit in recent times, we're still looking at some of the highest levels we've seen since the dot-com days back in the early 2000s. So it'd be easy to take a glance at this chart and be quite alarmed and a bit panicky that the share market's quite overvalued. But when we're considering valuations over different time periods, it's important we consider them in the context of what the market conditions were like at any given point in time. Particularly interest rate conditions, which can have a material impact on the valuation of a company. For instance, in the low interest rate environment that we're currently in now, low interest rates generally mean lower cost of capital for a company, and that generally justifies a higher share price for a company. So the yield gap is a measure that's often used to get a gauge for share market valuation in varying interest rate environments. And the yield gap is calculated by comparing the earnings yield from holding shares compared to the yield on 10-year government bonds. So it's essentially the risk premium from holding the riskier shares compared to the safer bonds. And over time, we'd expect this premium to be somewhat consistent. A higher than average earnings yield would suggest that shares are relatively cheap compared to the interest rate environment, where a lower than average earnings yield would suggest that shares are getting quite expensive. So if we compare if we observe the yield gap, I guess, over the last 20 years, we can see for both the Australian and the US market, the yield gap is currently hovering just around about its average for the last 20 years, around 2.5%. Now this would suggest that share valuations today appear appropriate given the current interest rate and bond yield environment. Now for shares to go, using this model, for shares to become, I guess, unattractive or overvalued or expensive, two things could happen. Either earnings don't keep pace with the price increases in shares, or we see a spike in bond yields, which can come about through increase in interest rates or an increase in inflationary expectations. So that leads nicely to my next topic, which I'd like to spend a bit of time on today, which is the inflation conversation. So aside from COVID, I guess inflation risk has probably been the biggest catalyst for market volatility over the last 12 months. Now inflation is simply, I guess, the increase in prices over time. And that's not to be confused with property prices or share prices. So a property boom is not inflation, they're not the same thing. Inflation typically refers to household expenditure like food, clothing, energy prices, transport costs, etc. So before we dig our heels in and look at some of the consequences of a higher inflationary environment, I thought it'd be worthwhile just looking at some of the common causes of inflation and how inflation comes about typically. So there's two main sources of inflation, generally demand pull inflation, and this looks at a shift in the dynamic of supply and demand. And this is led by an increase in consumer demand or a decrease in the available supply. Both will tend to drive up prices in the economy. And the other source is cost push inflation. So cost push inflation has to do with an increase in the cost of production for business, and they'll then pass on that extra cost to the end consumer with higher prices. So if we have a look through those causes of inflation on the board, we can see that most of these are actually playing out in real time today. We've seen interest rate cuts almost down to 0% across the board around the world. We've seen massive stimulus by the governments ever since the pandemic came about. We've seen supply chain shortages, a massive shortage in computer chips around the world. USA are having issues with used cars supply, so used car sales have gone through the roof. We've seen rising commodity prices, we've seen oil prices shoot up as well. Of note, higher wages have not come into play yet, and we're going to talk a little bit about that later as well. But nonetheless, pretty much every other cause on this board here is happening in real life today, and that's what's been triggering these inflationary fears. So I think it's quite common for people to associate inflation as negative straight away, and I think that's partly the media's fault. I think we're quite wide these days to hear the word inflation and we automatically think it's bad news. But there's certainly a good and bad side to inflation. For instance, a moderate level of inflation is generally good for an economy, as it tends to be associated with economic growth, higher wages, and therefore a better standard of living. And steady increases in prices is a lot better than a state of decreased prices in the economy, or what's known as deflation. During deflationary periods, the goods and services that we purchase are likely to be cheaper in the future than they are today, which really discourages consumers to spend their money, which has negative consequences, obviously, on economic growth. So central banks such as the RBA will generally target a small amount of inflation within the economy. In Australia, the RBA target a range of 2 to 3%. Now on the flip side, the main negative consequence of inflation is that it reduces the purchasing power of our money over time. So that means the cash that we currently have in our pocket won't be able to afford as much in the future as it would today. Some examples there. It'll take $2 today to buy what $1 bought in 1982, and it will take $6 today to buy what $1 bought in 1961. And this has implications on the assets that we hold in our portfolio in terms of how they're valued, such as shares, bonds and property. So as you'd all be aware, an income stream is derived from most of the assets that we hold. For instance, shares derive dividends, bonds pay interest, and property pays rent. And fundamentally, we can value an asset based on the present value of its future cash flows. Now, in explaining the effect of inflation on assets over time, I'm going to use a really hypothetical and simple example here. So let's say that I own one Commonwealth Bank share. CBA shares have typically paid quite a handsome dividend. So let's say that I'm going to receive, I expect Commonwealth Bank to pay me $2 a share per year for the foreseeable future. Now let's consider receiving these dividends in a low inflation environment compare it to receiving them in a high inflation environment. So you can see in this first example here that the low inflation or the nil inflation environment has very little impact on the purchasing power of my future dividends, and therefore has very little impact on the present value of my income stream. However, in the second example, the higher inflation environment actually does impact on my purchasing power on my future dividends, and therefore reduces the present value of my future income stream. Now, if you're a buyer for CBA shares and you had to buy one of these two, or had to pay a higher price for one of these two assets, which one would you buy? It's obvious, right? You'd buy this one. This one's going to be valued higher. So the bottom line is, during inflationary periods, the purchasing power or present value of assets, of an asset's income stream is reduced, which means people are now prepared to pay less for that asset, which ultimately means the value goes down. Now, this is a very simple and hypothetical example, like I said, but I guess the key message is inflation tends to have a negative impact on most asset classes, particularly those whose value can be tied to an income stream. Now, you'll notice that I said most asset classes, because there are certainly parts of the market, certainly asset classes and parts of the share market, that tend to do better than others during periods of inflation. For example, there tends to be a stark contrast between the performance of growth companies and value companies during periods of inflation. Now, growth companies, for those that don't know, can be defined as companies that don't earn much money today. In fact, they might be making a loss today, but they have extraordinary earnings growth rates, and they expect the bulk of their cash flow to be earned well into the future. Where value companies are typically earning quite a handsome cash flow today. So as you can see, inflation tends to impact those cash flows further into the future more severely than they do up front, which is why when in an inflationary period, growth stocks tend to be hurt a lot more than value stocks. There are also parts of certain industries that tend to absorb inflation pressure a lot better than others. For instance, the revenues of energy stocks tend to be tied to energy prices, and energy prices are actually a component of an inflation index. So naturally, as inflation is getting higher, energy prices are going up, and energy stocks tend to do just as good. Same goes for property, who have a bit of natural protection with rental income. Again, rental income is tied to inflation indices. And finally, banks can be beneficiaries in these types of environments where inflationary pressure leads to higher yields and higher interest rates. So where there's higher longer term interest rates, banks can take advantage by increasing their net interest margin, which drives their profitability. And fortunately for those who are capital partners, who are clients of capital partners, which I gather are most of you, capital partners portfolios will typically overweight value companies, banks, and energy stocks. And just to be clear, this isn't a tactical decision made by capital partners in inflationary risky times. Michael will talk a little bit more about this later, but we'll always try. Our goal is to construct a portfolio that gives you the best probability of having persistent returns over any period, whether it be inflation or non-inflation. So where are we at with inflation? We've talked about the causes and some of the consequences, but what have been some of the recent readings we've seen in Australia and around the world? So as you can see, there was a significant spike in headline inflation in Australia in June. Again, if we look at that on first glance, it can look alarming. However, the 3.8% year-on-year inflation growth was broadly in line with expectations, and it had to do with the abnormal circumstances that we saw 12 months ago, where fuel prices collapsed and childcare fees were waived at the height of the pandemic, both of which have been reversed today. So in monitoring monetary policy, in managing its monetary policy, the RBA will also give consideration to core inflation. Core inflation takes away or strips out some of the more volatile items in the headline number. So for instance, the fuel prices and the childcare fees would be stripped out, and therefore it gives a better indication of the underlying prices in the economy. Now, as you can see, core inflation in Australia at the moment is only 1.6%, still well below the RBA's target range of 2 to 3%. And we've seen this disparity between headline inflation and core inflation around the world. In the US, headline inflation I think has got as high as 5.4% recently. Core inflation is well below that number. And across China, Japan, and Europe, we're seeing core inflation somewhere around the 1% mark, so still quite low. So given everything that's happening, how high can we expect inflation to get? And when people ask me this question, I want them to consider a couple of things. There's a few things that I think they should be wary of. And that first thing is the inflation targeting regime. So the most recent, period we had where there was high persistent inflation was back in the 70s and 80s with the oil price shocks. So during those 2 decades, inflation averaged 8.8% per year. Which is hard to believe in this current environment. But during that period, there was no targeting regime by the RBA. So they only introduced this regime in 1993. And would anyone in the room like to have a guess at what the average inflation rate's been since 1993, since they introduced a 2 to 3% target range?
2.5%.
Bang on. So exactly right. So, and during that time also, economic growth has been higher, or faster growing, and unemployment's been lower. So it's been a really good initiative by the RBA on reflection. And to assume that inflation is going to explode higher than 3%, but also to assume that the RBA is probably going to let that slide and they're not going to intervene once inflation gets that high. And I think the RBA has probably proven with their track record that they've done a pretty reasonable job of managing inflation over the last 30 years. The second consideration to be wary of is the lack of wage growth pressure that's in the economy at the moment. So wage growth has been really sluggish in Australia for some time now. And it's widely argued that for wage growth needs to be somewhere in the vicinity of 3 to 4% to be consistent with inflation of 2 to 3%. So last week we got our wage growth number for the year, and it was 1.7%. So obviously still well below where it probably needs to be before we see some persistent inflation. So a common metric that the RBA will again monitor over time is the level of spare capacity in the labour market. So spare capacity is simply measured by those that are unemployed plus those that are underemployed, or willing to work more hours, if you like. So recently employment's done really well. Australia brought unemployment back to I think 4.6%. But just recently, we've started to see underemployment trend in the wrong direction again. And given New South Wales and Victoria now in lockdowns, and probably will be in lockdown for the next quarter, unfortunately, it's unlikely we're going to see any of that spare capacity come down any further. So what happens when spare capacity gets to a low enough level is it tends to force upward pressure on wages, which then leads to inflation. And this is exactly the relationship that the RBA will be wanting to see before it considers raising interest rates again. And like I just said, unfortunately, given this line's probably going to trend upwards over the next few periods, it's unlikely that we're going to see any real wage growth pressure anytime soon. The third and final consideration to be wary of, and I think it's a pretty key one, an underrated one, is deflationary factors and forces. With the key one being technological or technology innovation or disruption. So technology can lead to two things that are both very deflationary. The first one is technology tends to deliver better products at cheaper prices. And secondly, technology tends to lead to a reduced need for headcount. So just to give you an example, a few years ago, and you might remember this, NAB delivered its results for the period, and in doing so, announced that they were slashing 6,000 jobs at the time over the course of the next 2 or 3 years. So back then, NAB had 30,000 employees, and they decided to cut 20% of them just like that. The reasons being that they were going to bring in new technology, AI and automation to replace these staff. So we just reflect on that last chart I just showed you. We're trying to reduce spare capacity in the market to drive wage growth and inflation. Think about adding another 6,000 jobs onto that, and if all the other big companies in Australia tend to do that, it's going to have a real effect. On not driving inflation in the future. And I think that this is really one of the main reasons why we haven't seen inflation in the last 30 years. So just a final word on inflation. Do we need to react? Should we be doing anything differently with our investment strategy? And the conundrum facing investors is that although we acknowledge that inflation can have negative consequences on the assets we own, the alternative of not investing and perhaps holding cash on the sidelines is only going to reduce our purchasing power, given that the interest that we receive on cash accounts is well below the inflation rates. And whilst our expected returns on shares and bonds, for instance, are expected to be lower during periods of higher inflation, they will still produce higher total returns than inflation over the long term. And this next chart proves that. So this chart shows various sectors of bonds and shares during periods of high inflation. And it's showing us the real after inflation returns. So these are returns after inflation's been considered for. And you can see they're mostly positive during high inflationary times. So whether this bout of inflation turns out to be temporary or persistent, investors can best prepare themselves as always by remaining diversified across a range of asset classes and across a range of sectors and regions. So on that note, I'm going to pass over to Michael, who's going to walk us through a little bit more in more detail how we think about investing at Capital Partners.
Thanks, Luke. So before I get started, any questions for Luke? No? Get into it? All right. A little bit of this to me feels like I'm preaching to the converted. However, there's probably no harm in just going over some of the fundamental principles. Our crystal ball is no clearer than anyone else's, and the way that we recommend building portfolios is not the only way people can invest. So I just want to put it out there, it's not as if this is the only way. This is a way that we have researched going back now 30 years so that when you invest, you can be confident that the outcomes that you are expecting will be achieved. That's a very important statement, as in we wish we could predict the future. We wish today that we knew with absolute certainty what the returns would be over the next decade. It's just the world is not like that. And this is when we're dealing with investing, every time I present and every time I think about this stuff, which thinking about is a full-time thing, it's all about uncertainty. And none of us actually know what's going to happen tomorrow. But when we invest for the future, you are making plans on achieving a certain rate of return on your investments, not the least of which is you expect the money to be there when you need it. Okay, it's a given. So how do you know that? And therefore, the investment approach that we are talking about today is one that we believe will give you an incredibly high level of confidence that you will get a good return, or at least the return that you need, and that the money will be there when you need it. Now, I've framed it up, I've started the conversation this way, or the presentation this way, because the question around crypto falls into it, the question around inflation and QE and all of those, it all comes to this. Marcus, the question around sectors being overheated, which and why and what do we do about it? If we knew, and here's the thing, if any of us knew the answers to those questions, one of two things, well, in fact, many things would happen. There would be no premium, there would be no risk because there's certainty. Or if somebody knew that and wouldn't share it, they would charge you a fee for that knowledge. You with me? Like, as if anyone could predict the future, no uncertainty, no premium, no risk, no return. So it's almost you have to suspend. It's not like gambling. However, when people go to the casino, or you bet on a game of footy, or you bet on the races, and I have a lot of mates who do all of those things, it's fun. Like, human beings love to not tempt the gods. It's just we like to have a go, and if the consequences of loss are not significant, we tend to do it frequently. Investing is not gambling. Investing is, however, seeking to make money from an area of high uncertainty. And so one of the fundamental beliefs we have is that it works. Investing in equity markets, investing in property, investing in business, investing in entrepreneurs creates a return or provides an opportunity for people to earn a reward from, in some cases, being completely passive beyond the making of the investment. There is a reward there for taking on the risk or being exposed to the risk and uncertainty. So we think capital markets work. You may well hear from either me or whichever advisor you're working with that we think the likelihood of genuine loss and failure is as close to zero as it can get. It's almost the Chicken Little story. It's possible one day the whole system will come to an end, but it's improbable. And therefore we don't even contemplate that as a real potential scenario. And if it happens, we're all done. So therefore, we're thinking, notwithstanding the highs and lows, the ups and downs, we think capital markets will persist. There will always be a reward for investors who are exposed to risk. There is every single day a reason, though, why you should not invest. And every time we build this slide, it reminds me of all of the times that we think the world is coming to an end. I joined KPMG on this day in 1987. I got married 3 days after that. We went to a ball. Do you remember year 2000 when we thought the planes were going to fall out of the sky? 2007 was scary, admittedly. I mean, that was a really, really scary time. And then March, April last year, we had COVID. There's always a reason, whether it's the QE market. You look at it and you think, is this a time when we should be sitting on the sidelines because prices potentially, or some have the view, are not artificially inflated, just inflated as a consequence of the liquidity and the low cost of capital? Do you sit on the sidelines and wait? There's a guy, and I actually seek not to be disrespectful with this. Willie Packer runs the Investigator Trust, and for those of you who know that fund, and those of you who perhaps don't, for the last 15 or so years, that fund, headed up based out of Cottesloe, has done really, really well. In February of 2020, they made the call, the world's coming to an end, went to cash. March, April, the end of the world was nigh, and then very, very rapidly, I think it was the shortest bear market in history, poof, markets recovered, they got left caught short, and their reputation is not in tatters, it's just that when you market time, you have to make two decisions: when to get out and when to get back in. And you think about it, if we knew that, and it doesn't mean people should stop trying to find a better way of identifying the signals, and when most of the time this is going on, then you should do this. A guy called Robert Shiller in the US did it for Californian real estate, and won a Nobel Prize on the same day that Gene Farmer won his Nobel Prize for the asset class investing that we follow. So the irony there, Shiller came up with a range of what's it called, irrational exuberance, where they looked at the deviation away from the long-term average, and as soon as it got, say, 2 units of deviation away from the long-term average, that was a time to get out, and if it was 2 units below, it was time. And the guy was lauded, I suppose, for identifying a weakness in the California real estate market. We have tried, all of us in the investment committee have sought to apply that thinking to equity markets. And it just doesn't hold. There is no level of variation away from the long-term average that has ever been a reliable indicator as to when you should either get out or get in. And again, if it were possible, we would all be doing it. You with me? Like if the signals were reliable, even 51% of the time, all of us would be using those reliable signals. Do you want to get the truck driver to move his truck? Or lower the blinds? You want to go, no, seriously, you want to just lower the blinds?
How do I do that? I've never done it before. Just here, is it?
Yeah, it's that one on the other right, that one. That's it. So again, I sort of, whether it's funny or not, we and we're not being blasé about this. It's just, if we're trying to put a bit of humour in it, it's because when you think about the psychology of investing, we all have these moments when we either are overcautious or overconfident, and there's always some anecdote that we can have a laugh at. However, it's a very serious business. I'm sort of going to jump ahead a bit. We haven't updated this slide, but for me, it's the one that I always think of. So this is the US market, data up to 2018. It doesn't take into account the last few years. What we were going to show, and we all know this, is that if you think about returns, most of the time, whether it's the Australian market or the US equities market, most of the time the returns are strong and positive, and the reward justifies the risk. So this distribution curve for the last, 120 odd years of performance shows that there are a few really bad years, but most of the years are particularly good from a performance perspective. The same with the US, a bit more of an even curve. But this is the slide that I think of, which is most of the time equity markets tend upwards, and they go upwards for longer than they go down, and the magnitude of the up periods exceeds the magnitudes of the down periods. As in, it's almost, you might go, well, duh, like that's obvious. It's just that when you put this into some perspective, that's why the line goes left to right, bottom to top. The good years are much longer and greater in magnitude than the bad years. We don't expect that trend. I mean, the slope will change. We just don't expect that trend, or a belief that we apply, we don't know any better than others, is that we think that trend will continue. We think businesses will improve. Think about our own businesses. We seek to be better at what we do. We seek to provide better outcomes for our clients or our customers. We seek to do it more efficiently. We seek to make more profit to either reinvest in the business or invest in the community, or just for personal consumption. Most people in the business capitalist world are seeking to get better outcomes. I don't think human behaviour will change. Sure, there are periods of hubris, like 2005, 6, 7, and it got out of control. And then you might argue in 2009, 2010, it got out of control with fear. Certainly in April of 2020, things got out of control with fear, but only with the benefit of hindsight. So I really wanted to reinforce that point, that it is a belief that we have that you can capture really good returns out of financial markets for so long as you are patient and disciplined. And I'll go through now two things. Some of the myths, dispelling some of the myths, and perhaps most importantly, which begs the question why we don't put this at the front of the presentation, the actual process that we follow and the evidence that we use to support the way that we do things. As in, it's all evidence-based. There is no qualitative, speculative part to our investment thinking. So, the myths. Many, many years ago, there was a hedge fund in the US, Renaissance? Anyway. I think the guy's name was Jim Swinson, and they made billions of dollars. And I can remember reading about how this guy had received a bonus of $6 billion 1 year for the profits they'd made in the fund. And that was when $1 billion was a lot of money, like massive amounts of money. And he would say the reason I've made all this money was because I employ 150 PhD qualified mathematicians and engineers, and they are very clever at developing algorithms to identify opportunities and weaknesses in the market. As it turned out, their secret sauce was no more than they'd set up their trading room next to NYSE trading, so the data speed from the stock exchange to their system was a lot quicker than the data speed from NYSE to California or other places. And then once they put in place a speed regulator on the data, their super profits dropped off quite remarkably. So kudos for them for working it out. Are you with me? It was purely mechanical. You go, well done you. Like, it's not to sledge them, it's just, it had nothing to do with the intelligence of the people that they employed. And for being clever, it's worth $6 billion. So you remember when you were at uni? Well, it certainly was the case for me. Uni for me was in the mid-1980s, and inside knowledge in Western Australia back then, it was fun. Like, if you didn't have inside knowledge, find a broker who did. It was rife, and it was rife around the world. And it's true, you know, often people say, I've heard this, and what do you think? I say, well, look, if it's true, it's illegal, like, let's not kid ourselves. However, if you have something that the market doesn't know and you're prepared to exploit it, that's real, okay? Our belief is that most of the publicly available information, however, is already factored into the share price or the property price. There's no doubt, there has to be inside knowledge. The geologists somewhere who found something or not found something know something, don't they, before it gets released to market. Now, ethically, should you capitalise on that? We don't, but you can make a lot of money without inside knowledge. So, Mark, this is one of those mind battles, maybe, or mind exercises in terms of with all the QE, what do we do about market prices? And, you know, can I infer in your question that there is a concern about it being overpriced, or is it
for a sustained
period of time? Yeah, as in maybe this is musical chairs or a Ponzi scheme or something, or artificially. But either way, but to that point.
The thing I refer to, I think the historic average of these is about 14.
Yeah,
Depending
I
on
thought,
sector.
yeah.
But, you know, we've been above that for 12 years, I think.
Yeah, we could show that chart up again if we want.
And if you look at the graph on a long time frame, you can see what the average is. We've been paying a lot for stocks for a long, long time. And I suppose the purpose of the question is, are we in a sustainable situation, or are we kicking the can down the road with stimulus in a way that will come to grief?
Yeah, so in seeking to answer that question, the way that we process that question, that information, and many others is a belief that most of the information that is meaningful is already reflected into the share price. So where it were to be, because investing is effectively the consensus views of every investee. I mean, it's no more than willing buyer and seller, really. And there's no doubt that with compulsory superannuation and QE, there are more, and interest, bank accounts being whatever, paying 0.0 or 0 to 0.1 to 0.3, that investors are being pushed into equities when maybe they weren't, and supply and demand has pushed. However, at any point in time, our thinking is that the prices best represent what the prices should be. So they're neither overvalued nor undervalued.
Efficient market.
Most of the time, yeah. And that there are many people who don't believe that, and that's really, I suppose, one of the myths about the active stuff, which never changes, and which when we look at it, so what you're looking at here in the dark blue lines for the Australian funds and the global funds is over sort of 1 year and 15-year periods. The blue bars is the proportion of the forecasting managers who get it right. Sorry, dark blue, forecasting managers who get it wrong, and the forecasting managers who get it right. And what you get from that, and Mark, you might have seen this many times before, is that over prolonged periods of time, most of the forecasters get it wrong. And if you wanted to sort of dig your heels in, or sort of dig your boots in a bit, it's outperformance. There is no persistency. The only persistency with active funds management is underperformance. So I look at that and go, yeah, but why should we be surprised? You want people to go out and do their thing. It's almost the entrepreneurial spirit that, in the category of sort of 25 through 45, younger people tend to give it a go and they back themselves, which sort of is the average age of the active managers. But their predictability or predictive skills are no greater than anyone else's. And if they were, those charts would be reversed. I often think with the research houses, if the research houses were capable, because they sell them, the Morningstars and the Longsecs and all the rest of it, and the broking firms, that they sell research, which we used to subscribe to, you think, well, maybe they'd be in a better business of simply investing in the fund managers that they have identified, rather than being in the business of selling you the research to help you choose the fund managers in which you should invest. Or if you were a subscriber to that research and you were a fund manager, you would just simply invest in all of the other fund managers that the researchers identified. So it's almost a tail wagging the dog exercise, that advisors have thought this is what the clients have wanted, and clients have been educated to think that a marvellous advisor was one who could predict the future, or who... One caveat. If you had access to a broker who had access to IPOs, to floats, that was different to inside knowledge. There was certainly, through the certain broking houses in the 90s and 2000s, and maybe to this day, some broking houses give you access to floats. Most floats do reasonably well, but that was different from inside knowledge. Nonetheless, if the evidence continues to support that that the active guys don't get it right, why do people persist? Why do we even bother? And again, I think it's just human nature. We're all marvellously imperfect. We're marvellously flawed, and it's almost impossible to be ruthlessly objective when it comes to your own money. But it doesn't stop us wanting to get a better way of doing things. This next chart is, I suppose, offensive in some ways. You won't be able to read it, but the purpose of this is pick the pattern. What you're looking at there is the ranking of returns over the last 20 years, over a 20-year period from 2000 through 2019, across Finland, Hong Kong, Austria, Japan, Germany, UK, all of the developed markets mainly, ranking them from highest to lowest returns on a year-by-year basis. And the question I would put to you is, what pattern do you see? And you would go, none. As in, the only pattern is there is no pattern. And there isn't one. And if anything, the old adage of, last year's underperformer will be next year's overperformer and vice versa, no, there is no pattern. Why? Because if you could predict it, you would, and the risk premia wouldn't exist. I don't know. Good luck if you can find a pattern. I can't. I see no. There's a
few top performers that become bottom performers and vice versa in consecutive years. You look at Finland and you look at Canada.
Oh, okay. You're in here and here and here. Okay.
Yeah, but that's
roller coaster.
Yes.
Yeah. Anyway, the other bit is market timing. And we've talked about it a little bit in terms of market timing involves two decisions, when to get in and when to get out, or when to get out and when to get in. And what we often marvel at is I think it's the barefoot investor, which my 17-year-old son said to me the other day, Dad, for Christmas, I'd like you to buy me the Barefoot Investor book because I think I want to become an investor. And I thought, mate, how good is that? You can become a genius from just reading one book. The first book you've ever read in your life, which would be true, however. But they talk about, markets being overheated, underheated. And so when you look at they sledged the buy and hold strategy in a way. And there was a beautiful article we got out of the US the other day that said it's laziness and contemptuous to have a buy and hold strategy. You should be actively moving your money around based on a range of signals. So what this chart shows you in essence is that over a 16 or 17 year time period, and we can do it over any rolling time periods, that over that 16 times 300, whatever, over that period, 2003 through to February 2021, if you missed the best 10 days, not per year, but over that time frame, you would have made $26,000 for just sitting there, just being an investor in the Aussie equities market. But if you had have stayed the course for the entirety of the period, you would have made $43,000. So whatever that works out to be, $17,000, which is 60 or 70% of the lower number, you would have missed out on for missing just 10 days over that 17-year time period. Again, if you could market time accurately, you should. You with me? But it's a perilous game. I was interviewing a CEO the other day as part of a business owner project that we're working on, and after all of these years, it finally dawned on me why it is that we really struggle with being passive investors. And if you just had done nothing for the last 43 years, it happens to be 43, but whatever the period of time is, in the Australian equities market, you would have made a compound return of 12% per annum going back over the last 43 years. So the risk is that you miss out as a consequence of doing something. But in almost every other pursuit in our life, how do we make our wealth? From decisions, from doing something, buying, building, selling, constructing, improving, adding value. So you go from being an enterprise or a profession or a business where you've created your wealth as a consequence of decision making and activity, and then you get people like us that go, now I want you to do nothing. Because today's about the evidence of how, so we're not being passive and reckless or complacent, but the challenge is you actually just have to let it run its course. You have to run through the good years and the bad years. You have to have the capacity to be exposed to the markets. So we get it. A lot of this is the psychology of investing.
Michael, can I ask you a question though? So from for me, there's two halves to the equation. So you've always encouraged us, or me specifically, about the merits of passive investing
Non-forecasting, perhaps, yeah.
But what I'm curious about is how passive are you? Not behind the scenes, right? Because we invest in a class of, a variety of classes of assets. But I'm assuming that behind the scenes,
Highly active.
you're very active about making sure that within that
Every day.
passive investment strategy, you're very active trying to eke out the best.
Okay.
You know,
You are absolutely
once
right,
you
and I'm
after
glad
that.
you've asked the question.
Yeah.
So our philosophy is this, and we're not sort of the only people in the world who follow this, is that we call it evidence-based or asset class investing, of which there are 4 key principles. You know, the drivers of return at this point are from the equities, not the fixed interest. The fixed interest is just a store of liquidity. So four factors. Markets work. You want to buy businesses that are better value, as in lower price relative to their balance sheet. You want businesses that are smaller than average, and you want to invest in companies who are more profitable than others. So the primary driver of the return is buying well, beating the market by having a tilt to smaller companies, and of those you want the ones who are more profitable. And again, this is publicly available information. And the evidence, as best you can read it, continues to be small beats large, value beats growth, profitability meets high profitability is better than low profitability in the Australian context, and certainly in the US and every other developed market. So to your point, the definition of value is simply the companies whose share price or market cap is lower relative to their book value, the NTA. Okay, it's not a perfect measure. Luke talked about PE. Price to book is a more stable measure from a quantitative, as a metric. It's a more reliable metric. However, it's a valuation methodology. So the philosophy is simply you buy the lowest 3 deciles, bottom 30% of all the companies ranked on price to book. So a growth company has high price to book, because you're happy to pay a premium for future profitability because you own to back it. And maybe it's a brilliant company. This is not saying good versus bad. It's just what are well priced and what are, as in, I think companies like Apple and Amazon and Tesla and what are extraordinary. I mean, I'm really love to see where they go. Google, as it takes over the world, what it does. They're just really well priced. So from an investor perspective, I want something that's not yet really well priced. Does that, you with me? So, and to that end, every single day, behind the scenes, the managers, whichever ones, and our primary research group is with the Dimensional guys, every single day seek to, being conscious of tax issues and trading costs, seek to have the portfolio optimised to give you the highest expected return going forward every single day. So that they are highly active. It's almost 24 hours a day. So, and we need to differentiate between passive and active versus forecasting and evidence. So we're not passive investors at all. No, we're disciplined, if you like. We follow a system based on evidence, but we're anything but passive. It appears passive when you see your portfolio valuation report and you say, well, I'm in this fund and it's gone from this value to this value. The name on the report tends to not change frequently, which paradoxically is actually a really good thing. It means that you were in a good investment, it remains a good investment. Under the lid though, the portfolio changes every single day. Yeah. So in those last 2 slides, the real gold actually in this presentation, and again, I'm actually really pleased to see you here, Mark, because this must be presentation 3 or 4 or 5. I'm going to get you to help me present this next time I do it. This is the evidence, if you like. The last 2 slides, this is the chassis, this is the framework that we follow. And we're doing it because it's the only system, the only methodology, the only investment approach that we have found in the last 30 years, and there are thousands of us around the world trying to find a better way all the time, this is the only one that many of us, about half the world now follows this investment philosophy because they've given up on the forecasting approach. Value, size, profitability, get on the field to try and win the game. Those four characteristics tend to be those four characteristics can describe 96% of a portfolio's return relative to a market average. So it's a pretty high correlation. You can look at it and go, this is done well or this is done poorly for various reasons over prolonged periods of time. I mean, you can't use 3 to 6 months as a meaningful time period. And these numbers just back it up. And it sort of makes sense, doesn't it? If you buy low, you sell high. You buy small, you sell big. And whatever you buy in the small space or the value space or even the large space, so we're not out of large growth space. It's just that there's a tilt towards value, a tilt towards small, because some of the big companies are still worthy of investing in. The Apples and Microsofts and Google, they're worthy of investing in. You're just underweight relative to market, and you overweight the lower price companies. So post-COVID, the value investing overweighted the banks and the energy companies in the few months post-COVID. Why? Because they represented extraordinary value. And I was saying this to you yesterday, Marcus, it wasn't that we had a view on banking or energy stocks. It's just that relative to growth stocks, those companies represented really good value. We've never done this before because it's not so much blowing our own trumpet. It's that the question, I think that is a fair question, is so the theory is wonderful, but does it work? The approach that we recommend for you, this is the blue line versus the cream line. That's the outperformance of the Capital Partners approach over the last 25 years from an Aussie equities perspective, and similarly from a global equities perspective, which you would find should be very consistent as a consequence of having a tilt towards value and small. There has been outperformance. It's not a conscious issue, but you probably can't read the red. But the red's real, and that is that certainly in the global space, the level of underperformance, while not significant, well, it's not insignificant over the last few years, was because the value investing in the Northern Hemisphere up to from 2018 through to 2020 was smashed because all of the tech businesses were doing really well, and good on them. That they deserved their time in the sun. Because of the way that we overweight value and underweight growth, it meant that we were underweight tech from 2018 through to 2020. Rightly or wrongly, I don't know. I mean, I think we're all lovers of tech and what the world is. .com was just 10 years too early, really, wasn't it? Well, that was what the boom was. But in more recent times, the value approach has returned. The final little bit. Are we on time? We're right. We touch over. Okay. The final little bit is just looking at the persistence of the approach relative to the alternatives, and over rolling 20-year timeframes, the value small profitability approach has outperformed over rolling 20 years all the time, 10 years 70%, 5 years 65%, and over 1 year, rolling 1 year timeframes most of the time. So we were going to touch on a little bit of crypto in a way, and it's dawned on me, without fear of stating the obvious, that the approach that we are espousing is fit for purpose, where the purpose is to get a much better rate of return than you could from cash and fixed interest, a rate of return that, adjusted for risk and net of fees, gives you a pretty good outcome. So it has to be above market averages net of fees, else you wouldn't do it. There may be ways of making more money. I'm not refuting that. It's just on a risk-adjusted basis, the approach that we are espousing is to make sure, whether you call it foundation wealth, core wealth, most of our wealth, whatever, it's for that purpose. The likelihood of it blowing up is almost zero. The likelihood of getting an above market return persistently is high. The likelihood of the money being there when you need it, very, very high. It's not private equity, it's not leveraged, it's not hedge funds, it's not crypto. Luke's about to talk about, albeit briefly, the ethical investing, which some clients have a really strong desire for, and curiously, some clients are really anti it. We didn't expect there to be such a polarised view on ethical investing, but maybe that's human nature. So, in crypto, so the issue is we're not anti any of those alternative approaches. We're not anti-commodity. We're not anti-tech. We're not anti-crypto. You know, I think if I were to pick it, I think crypto is simply 10 years ahead of its time. My sense is that we will all be using a version, if we're not already, of cryptocurrencies for all of our transactions. You know, it will become mainstream. I just can't see the intrinsic value at the moment, but for its speculative value. And if you get on at the right price, like, fantastic. It's just, what for the main purpose, most investors need that, almost like Maslow, you've got to get your house in order and you invest sensibly and you don't punt. You take on risk, not failure risk. And once you've got all that covered and you want to have a bit of fun, because not everybody does, then you can start looking at crypto, private equity, commodities, infrastructure, stuff that might go through the roof. But if it fails, it's only going to annoy you rather than compromise the achievement of your objectives. So I'm trying to give a balanced perspective. So look, I have put some money into crypto, and I thought I did my dough, and then we got in at about 35,000, and the other day I thought it had gone up to 70, and I thought my day job's wasted. I should be getting. But then I realised it gives me, I have no interest in that. I don't get any buzz, literally, which is why I'm not a gambler. It did nothing. And it's purely speculation. But again, like, give it a go if that's the way you're wired. So my final slide, and I know you're thinking wonderful, my final slide is, and this is really important, it's not just about the selection of the managers or the asset allocation and following trends and being aware of QE and inflation. I mean, we have to be aware of that stuff. The most important thing is, for the risks that we are recommending you take on, we need to know that you have the capacity to be able to withstand or be exposed to those risks. Historically, it was about how do you feel about investing. Almost everybody on the planet is loss averse. I don't know anyone who's not risk averse or loss averse. So asking you, how do you feel if the market fell by 20%, happy, unhappy, neutral, disappointed, annoyed, frightened? What are you going to say? I mean, but it was better than nothing. So we're not ignorant, and we do care how you feel. However, we start with, what rate of return do you need? What are the risks that you should be exposed to achieve the results, the returns you're looking for? And what's your capacity for risk? And capacity is a function of time frame and alternative sources of funds. We find that if the structure is right and there's enough in liquid assets to meet your commitments, and the money in the bonds and the deposits is not to make money, it's for there for when you need it, and certainly so you don't have to sell down your equities in a down market to fund living costs. So it's a store of wealth. If you've got the capacity, and after you've experienced a few bad years and your money's still intact, we find people's preparedness to stay the course is a lot higher. But there's not one of us who doesn't get a little bit uncomfortable, in some cases very uncomfortable, when we see the value of our equities in real estate drop by 30 or 40%. It's real. So we're mindful of how you feel. As an advisor, as the person, you know, Dave, Andrew and I are the responsible officers, and we're the ones who actually cop it if you sue us. We make sure that before you implement the advice that our advisors give you, we test that you've got the capacity to withstand the shocks. And generally, if you needed a rule of thumb, and we were reminded of this in 2007, if you've got 4 to 5 years, it's a rule of thumb, however moderately reliable, 4 to 5 years of your forecast expenditure sitting in risk-free assets, because most of the time equity markets take fewer than 5 years to go from peak to peak. Okay, so if it's with the COVID stuff, it's whatever, a few months. But if you've got 5 years in risk-free assets as a minimum, then you're very well positioned to participate in equity markets. The last thing you want to have to do is be selling in a down market. You don't ever want to have to be a forced seller. So when we're building your asset allocation, this 60, 40, 70, 30, 50, 50 stuff that you might see on paper, what's behind it is a consideration of, yes, but how many years worth of spending or of consumption do you have in risk-free assets? That's the capacity-driven thing. So it's not just all positive blue sky stuff. We're thinking equity markets will go that way. We do make sure that you are well placed to be able to enjoy the journey and not rationally have any cause for concern. You've got 2 minutes.
Thank you, Michael. So just to touch quickly on sustainable investing, Capital Partners have actually invested a lot of resources into research for sustainable investing in recent times. And we've got an offering that we believe is just as good as our conventional offering. So in the sustainable space, I guess this is the Capital Partners' objective. It's to align investors' environmental and social priorities with their investment goals. So there's various approaches to sustainable investing, and you can sort of view them along a spectrum if you like, where the left-hand side's probably less impactful and the right-hand side's maximising impact. So a passive approach, for instance, would typically hold a conventional portfolio of all types of companies across all sectors. And I guess your impact is limited to your shareholder power and voting through AGMs and things like that. The sustainable outcomes are probably secondary to your financial objectives within a passive approach. Now, if we go to the other end of the spectrum, to the impact approach, this is where we're trying to maximise impact. And I guess investment strategies within an impact approach might be more targeted. For instance, they might only invest in renewable energy. They might only invest in electric vehicles. They might only invest in water treatment companies. So you tend to trade off, I guess, a bit of that diversification when you take an impact strategy. And when you trade off diversification, you tend to trade off, I guess, the reliability and certainty of investment performance. So the middle ground is the integration approach, and we find that this is where a lot of our clients fit. Within the integration approach, we're trying to balance, I guess, investment objectives with sustainable outcomes. As a dual objective, we're trying to achieve both. And how we go about doing that is we start with a conventional portfolio, and then we apply some ESG screens to remove some of the bad companies or the companies that have a negative impact on the environment. So here's an example of some of those ESG screens. So ESG stands for environmental, social and governance. Environmental tends to deal with carbon emissions and minimising carbon emissions. Social is companies that have a material amount of revenue associated with these social activities will be removed from your portfolio. And governance can also exclude companies based on severe controversies, as well as use shareholder power, I guess, to promote better corporate social responsibility practices within companies.
In the extreme, would that put the banks in the target being subject to the Royal Commission?
Correct. So
such a foundation sector.
Yeah. So if it was a severe controversy, it'd certainly be looked at. The thing with the integration approach, I'll just go back to here, is we can't eliminate every single client that's ever done a bad thing, because we still need to maintain some of the diversity. Like I said, it's dual objective. So you still want to have that diversification. You still want to have that reliability of, I guess, investment returns, whilst also getting the best the best sustainable experience that you can get. So it's a bit of give and give, both sides. Where the impact is you're just going hard at those industries that are doing that are enabling change, I guess, if you like. So a quick look at performance, and this is ESG performance. So this is a global ESG index compared to just the global market benchmark over the last 10 years. So you can see that performance has been quite similar. It has outperformed over the 10 years, and we have seen a big shift towards these companies. And I guess there's two trains of thought. A lot of people often ask, will my performance suffer if I move to ESG? Or will my performance improve if I move to sustainable investing? And there's two trains of thought there. People that advocate that ESG will lead to higher or more improved investment returns will often point at the risks that are inherent with non-sustainable companies. So that's operational risks, litigation risks. And it's argued that performance can improve if you eliminate those companies with higher risks. On the flip side, there's also been lots of research papers written to suggest that due to all this, like this shift in demand towards sustainable companies, it's driven the price up for these companies. And what that means for new entrants coming into the industry wanting to get into sustainable strategies, they're having to pay a premium for these sustainable companies and therefore would have a lower expected return when you buy these companies compared to more relative or better value companies that might not be sustainable. So there's arguments both ways that could lead to higher performance or lower performance. Our view is that over the long run, so long as you maintain a level of diversification, you should expect quite similar returns over the long run. And obviously you'll see periods of underperformance and outperformance along the way. So the beauty about sustainable investing is it's not all about the investment returns. So we can measure, I guess, the sustainable impact we're having by investing sustainably, by investing through ESG. So this chart here looks at, I guess, the capital partners' current global sustainable strategy. And you can see by investing through this strategy that you're reducing greenhouse gas emissions by 92% compared to a portfolio, just a conventional portfolio that holds the market. You're reducing your emissions from reserves by 100%.
What do you mean by that?
So this is, these are the companies like BHP and Woodside that have like fossil fuel reserves. So they generally get eliminated in our strategy. They won't be held. Greenhouse gas emission intensity could be things like Qantas or companies that are putting carbon emissions out into the environment. So you can see that you can get quite a similar performance with investing sustainably, whilst obviously making quite a sustainable impact with this strategy, which is why we've seen a lot of clients.
And just to make the point, we still start with the evidence-based stuff in terms of value, size and profitability. So the ESG doesn't replace that, it's just an additional filter or an overlay.
That's right. So the evidence-based is our bedrock. That's our starting point. I should have suggested that. So that's the starting point before we bring in these ESG screens. So that concludes the presentation.
So with your example with BHP, for example, was that get excluded or just underweighted as a result?
BHP is excluded, I'm quite sure. Yeah, so is Woodside.
So there's no sacred cows?
No, look, like I said, I think with ESG, you still want to maintain, with the integration approach, you still want to maintain diversification. So it excludes the worst of a bad bunch, if that makes sense, and still keeps it reduced weight in the best of the bad bunch.
And the challenge from an Australian portfolio construction perspective is just the limited number of businesses. So as we all become a lot more comfortable with having a more globally diversified portfolio and just maybe manage some of the currency risk, then probably the better diversified ESG portfolio is a global one. And you just have to accept that you're underweight Aussie and maybe your franking credits are not as valuable, which again the research suggests that they're not, that franking credits are already factored into the share price. So if you're tax agnostic, then a globally diversified portfolio is a better place to be invested.